Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. It's a brand new week. The S&P 500 still above 6,000.
It feels like a little bit of calm has been restored.
A little bit. We'll see how long that lasts. Let's get to the biggest stories right now in the more than $15 trillion global ETF industry. Oil continuing to fall, wiping out earlier gains as Iran reportedly wants to restart nuclear talks over those programs, escalating fears or easing fears of escalation.
We'll be speaking with Invesco's Kriskey on the funds that track the swings in oil and other commodities. And in just a few moments, we'll speak with Tushar Yadava of BlackRock on the firm's goal to continue to lead the industry in its use of active ETFs. Balchunas is on assignment this week, so Katie is looking at flows. She's doing double duty. Katie, what do we have?
Well, let's talk about where money was going in the week that was. We'll start with the good news. There's a lot of funkiness in the week's flows, and you'll see that right at the top because we have VU taking in $14.5 billion last week. A lot of speculation about whether or not this is a heartbeat, whether we'll see this money come out, and we'll see something funky on the outflow picture as well. But at least at the top, you have VU, and then you have BND. So appetite for bonds as well. SPLG, that taking in $1.5 billion as well. So demand for bonds and demand for index tracking stocks. Let's take a look at the outflows right now. As I warned you, right up at the top, we have IVV losing $22.6 billion. Again, this is a funky one, so just cover your eyes and look past it. Down at the next level down, you have Qs losing $1.9 billion, so maybe some appetite cooling for tech as well. And then some money coming out of investment grade credit and then Vcash. I want to talk about active versus passive. This is a debate we talk about often when it comes to flows, but I wanted to look at this from the number of products that have launched. In white, you have the number of active ETFs. Their share of the marketplace is now 51%, forming this really cool chart where you can see the white line overtaking the blue line, that blue line being the number of passively managed strategies. So, Scarlett, a real sea change in this industry.
Absolutely, and it's something we've been tracking for a bit now here. Katie, thank you so much. Joining our conversation right now is Tushar Yadava. He is market strategist for target allocation business over at BlackRock. Tushar, great to see you here.
Thanks for having me. Miss Eric maniacally walking around at the start there.
Me too.
He'll be back next week, and
Don't
of course we'll have you back.
So.
Well, maybe we'll remote him in.
Yeah.
We're going to get to active versus passive in a moment, but I did want to get your take on the markets overall here. Stocks have really been in a slow melt-up, despite a lot of uncertainty everywhere we turn, right? That could be the Middle East conflict. That can be the ongoing tariff story. Also, the worsening economic outlook, despite inflation being fairly tame. What does this all mean for how much risk investors should be taking on right now?
There are enough inputs in there for you to worry about.
Exactly.
Look, I think we recently rebalanced our model portfolios, a few weeks ago. And importantly, we waited until after a lot of the sort of fallout from Liberation Day. We were always of the belief that we would see some sort of move back to where we are at the moment, because I think at the end of the day, earnings are still coming through strong. Economic growth is still, has a strong foothold, I think. And we've always been on the optimistic side with inflation. So I think you're sort of seeing some of those factors come to pass in the market at the moment. And that's obviously what's sort of driving where we are today. We rebalanced using the opportunity to sort of bring that market back after we'd seen a lot of that rebound to now start bringing in some active bets on the equity overweight, but putting them maybe on the active ETF side, which you talked about at the start as well.
Yeah, definitely. And I want to get into all of that, but I do want to talk about, your position right now. Of course, you're part of BlackRock's models team. I think of you guys, controlling the puppet strings. It just feels like things shift so quickly in this news cycle, in this market cycle. And you're talking about how, you made some of these portfolio decisions a couple of weeks ago. I mean, have you sped up those processes at all, or are you thinking about rebalancing more frequently, or are you just trying to look through the volatility?
It's a really good question. Our clients ask us a lot about when we do and when we don't trade and what drives both of those. We recently had a conference with 75 of our top custom model clients. It's about $1 trillion of AUM in the room, and about 20% of them responded that they're always sort of, their biggest question is uncertainty in the market at the moment, recession, risk off, volatility. So it's on their minds. I think what we are trying to do as a client business and respond is thinking about ways that we can be active in the portfolio without having to trade it every couple of weeks, because the incoming headlines and the news flow can really sort of lead you astray if you're not laser focused on what the outcome outcome is, and where you think you're able to get the best exposures for what we're trying to do in portfolios, which at the end of the day, we're trying to get to that sort of smoother ride and that longer term return for our clients, and I think that's what they value.
I want to ask one more question on the role of fixed income in the portfolio, especially U.S. Treasuries. How do you see them? Are they havens the way that they've long been? Or because of all these existential questions about the U.S.'s fiscal path, there's less confidence in them as risk-free investments? Or are they a way to express inflationary concerns because of the conflict in the Middle East? They are kind of defying a lot of expectations right now.
So how much time have we got for this answer? No, look, I think Katie and I, we were on a panel in March, I think, talking about fixed income.
Long time ago.
Yeah. Since then, I think what we've done in the portfolios to sort of reflect that is, yeah, we're still holding treasuries. They're still part of our risk-off, portion of the portfolio. They're a ballast to the stock portion of the portfolio, which is where we want to make money and where we think that we're going to be compensated for the risk that we're taking. But recently, in our most recent rebalance, we actually added to international developed bonds, international government bonds as well. Just trying to take a few, advantages. Very busy central bank week this week, as I think you'll find. And much of the narrative is about how global central banks are going to try and get ahead of the Fed in the rate cutting cycle, right? And so there's an opportunity there in global bonds that I think that we're looking at. And there's also just less rate volatility in the global market. And most of these yields are pinned in the same way. So we think that there's an opportunity there. We leaned into some of that, but at the same time, we're not cutting weight on treasuries in any way, shape or form. There's still a big risk-off part of the portfolio.
So if I think back to that conversation in March, we were at the Exchange Conference in Las Vegas, steps away from the casino floor. Private credit was a big part of that conversation. There's been a lot of interest and intrigue around private credit, particularly in the ETF wrapper. Is that something that BlackRock is considering adding to its models?
So I'm on the ETF buying side of the equation rather than the launching side. And I feel like every time I'm here, you ask me about a product that hasn't been launched or that we don't have in our models. But I do see where your interest is coming from. I think from our point of view, we're a client-led business. There's always a lot of interest in these types of areas and exposures. And if there's something that can help the risk-adjusted return for clients, that's always going to be of interest. At the moment, I think the industry is at a point where our models with alternatives, so alternatives that include liquid alts as well as digital assets and gold, have been very, very strong performers this year. That's where we're seeing a large amount of client interest. I think as the industry continues to evolve, I'm sure private markets will eventually be part of that.
Well, let me ask you something that you definitely have insight on. And when it comes to your models, as I understand it, you have about $150 billion in assets. Maybe it's a little bit higher now. How much of that AUM is BlackRock's own money versus external money from clients, perhaps?
That's all client-driven money. It's all money that we're managing on behalf of clients through third-party platforms or through custom mandates entirely. So it is entirely managed for clients and by clients. Every decision we make in these portfolios is investment-led first and foremost, and our only goal is to try and beat the market in a better risk-adjusted manner than the benchmark itself.
Katie talked a little bit earlier on about active versus passive and those lines intersecting. Active ETFs are punching clearly above their weight, taking in 40% of net flows this year, despite making up 10% of assets, and they make up the majority, the lion's share of new launches. Why do you think that is? Do you think we've reached saturation with passive ETFs, or is there just less appetite among issuers to come up with new passive funds?
It's a great question. I don't run an ETF business, so maybe someone that does can opine on that. I can tell you as a consumer of ETFs, look, we follow where our clients' interests are first and foremost, and we try and make the best investment-led decisions for them. Active ETFs are presenting a ton of opportunities at the moment. We, in our model portfolios, I think we're one of the largest holders of active ETFs in the world at the moment. We own just, even outside of iShares, we have about 27 active ETF providers that we own in our model portfolios for custom clients, over $3 billion there and another $15 billion in iShares. I think from our point of view, it gives us a tremendous opportunity to bring active management into the portfolio, to bring expertise into the portfolio, and to bring in the sort of ability to trade and respond to market environments that are just moving far quicker than a model manager that rebalances on a fairly set timeline is able to bring into clients. So that's a huge value add, and there's a big reason why you're seeing those shifts in flows.
Before we let you go, I have to ask you about Bitcoin as well, because you rewind back to the end of February, and one of the news items that broke was that BlackRock was adding a 1 to 2% allocation to IBIT in those target allocation portfolios that also invest in alternatives. So a pretty small weighting in a very specific subset of your model portfolio business. Have those numbers bumped up at all, or are you thinking about adding it to a broader subset of your model business?
No changes from that initial guideline at the moment. I think that's an area where, as a business, I think we think that that's the right amount of volatility to bring into portfolios. It's done exactly as advertised. It's given us a great sort of lower correlated advantage in those portfolios, and that's why clients are increasingly turning to that target allocation with alternatives portfolio, because it's offering such a great diversified source of return in this market environment.
All right, Tushar, it's always great to see you. That is Tushar Yadava of BlackRock. And coming up, Circle continues to soar, and issuers are getting in on the stablecoin craze. We'll discuss next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with where the money is going, and increasingly so, it's going less to the cheapest ETFs on the market. ETFs that are charging 10 basis points or less. They've taken in less than half of the flows so far this year. You can see that is much different picture than the last couple of years. So we'll continue to monitor this one. But let's talk about Circle. It IPO'd less than 2 weeks ago, and ETF issuers kicked into overdrive. Within hours, you saw 3 issuers come to the SEC with applications for single stock ETFs that would track Circle. So really, again, going into overdrive there. Also want to talk a little bit more about leveraged ETFs and their trading volume overall. I love this chart because we're close to a record when it comes to leveraged ETF trading volume, as you can see with those big blue lines. But we've been here for a while, Scarlett. It really drives the point home that leveraged ETFs, they've been hot and will continue to be so. Yeah, they're not going away anytime soon, whether it's double or triple. Is there anything past double or triple? Not yet. Maybe over in Europe. Okay. All right. Well, this week is Bloomberg's ETF In-Depth conference event. Well, conference event both in Europe. And if you're wondering where Eric is, our very own Eric Balchunas is in London, and he joins us now. Eric, ETFs In Depth is a global franchise that both Katie and I have had the pleasure of participating in here in New York. What are you looking to be the big themes in this European edition?
Really, over here, it's the retail investor. They've long just had institutional investors in the market here, but the population here is starting to look to save for their own retirement, which is something you really need to get ETF growth. People need to not assume the government's going to cover its retirement. They need to think they have to plan it themselves. By doing that, you become a smarter shopper of funds, and that leads you to the ETF because it's a good deal. And that's something opening up here. Another big thing we're looking out for is the trend of European defense. This theme has gone wild. Here they have 11 billion, which is the equivalent of 55 billion in the US. So that would be like half of all theme ETF assets, because there's a lot of money that's going to be spent here, given some of the situation with Russia, Ukraine, and Trump. They pouring a lot of money into defense, and that is an area where all these issuers are like piling in, trying to get some of those flows. That's also something that I'm sure will come up. Well, let's talk about whether or not there's going to be any victory laps being taken when you talk to these Europeans, because something we talk about on this show all the time is the false dawns we've seen when it comes to European stock outperformance versus the U.S. It's almost halfway through 2025, and this dynamic still holds, Eric. I don't think a lot of people would have expected that. Yeah, look, you got to give up and acknowledge the W. 23% year to date, U.S. is up 3%. That said, it seems like the U.S. is down 10, 20%. So just to be up 3%, I'd say is a victory on its own. But you're right. This looks like a year that is Europe is going to take. Now, will that last? Athanasios did a great study on my team that when the band of performance is this wide, typically it snaps back. And I do think even here, as I talk to people, they do love their NVIDIA, their Apple, their Google. Like, everybody wants to own these companies. That said, this year, especially since the tariffs, they have moved much more of their money into Europe, especially because they get more returns. So I would think the U.S. would have to go on a nice run and like run a whole circle around Europe to get the money back out of Europe into the U.S. But U.S. investors are sticking with the U.S.
Yeah, there's also the added element of the U.S. dollar and its trajectory as well. Eric Balchunas, thank you so much. Enjoy Europe. We'll see you back in the U.S. next week. Still ahead on ETF IQ, the Iran and Israel conflict is driving volatility in oil prices, so we'll be speaking with Invesco's Kriskey on the firm's fund tracking that commodity and other commodities next. And a reminder that you can listen to Eric and Joel Weber on Trillions, their podcast that covers the entire industry. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu here with Katie Greifeld.
And it's time for today's drill down, where we focus on one ETF. And in the hot seat this week, we have the Invesco DB Oil Fund. The ticker there is DBO. This is an ETF that tracks futures contracts on WTI. It also does some fancy footwork to try to mitigate that negative roll yield. It has about $224 million when it comes to total assets. It's not an actively managed fund. It's passive here, and it charges about 76 basis points. You take a look at the holdings, and it's what you would expect. It's pretty short list compared to what we usually do in drill down. You have crude oil contracts right up at the top and then some cash there as well. Let's take a look at performance, and this is where things really get interesting. We're taking a look over a one-year basis, and you can see that this ETF, the white line, has trailed relative to the S&P 500, for example, but then you zoom in and you take a look at the last couple of weeks. We're talking about this ETF in part because of what's going on in the Middle East right now. The conflict between Iran and Israel has been boosting crude energy prices, and you've seen that show up in this ETF, Scarlett.
Right. Fantastic setup there. Katie, joining us now to talk more about this ETF is Kriskey. Kathy is head of alternatives ETF strategy over at Invesco. So Katie was talking about the price action there, and we saw that on Friday it closed at a 2.5-month high, and volume in this ETF and DBO really spiked on Friday as well. When we see that kind of price action and that kind of interest, is it a sign of people coming in and starting to build positions in these kinds of funds?
Yes, and unfortunately, I would love to say this is the best time to buy DBO, but what happens with investors is something dramatic will happen, like this, the current conflict, and people chase it. They chase the markets. So I would love that if people on this, watching the show would say like, oh, I already own it, I've got it, or I've got PDBC, the broad-based one, or whatever commodity investment they have, and they're watching this, because why do people invest in commodities, right? They want hedges. They want a hedge to inflation. They want a hedge to geopolitical risk, but they also want diversification. So on Friday, when you notice when this DBO was going skyrocketing, right, what were equities doing, right? They were down. And that's where I love days like that, because it proves our role as a diversifier and how important that is, right? And so again, it's very tempting to chase a market, but I would argue you're better off if you're the dip buyer. And I think that commodities should have a constant allocation in a portfolio. And it doesn't have to be big. You know, we always joke about 5%, but it can be 1 or 2 or whatever. But it needs to be in there. So to protect your investments on days like Friday.
Right, right. Well, I want to talk a little bit about the price action, and I love what you're saying about, you know, having a constant allocation. You don't want to be chasing here. But something that always, I don't know, I never know how to explain it when it comes to the energy market in particular, is that it just feels, especially over the last couple of years, that crude oil can't hold a bid. You see sometimes that you see some of these risk premiums built in, but it feels like more than anything, this is a supply-driven market. Is that still the case?
Absolutely, and that's why, look at 2 weeks ago, right? Everything has changed in the past 2 weeks. So 2 weeks ago, crude oil, WTI was at 60, it even broke 60, but around $60. Right now we're in the 70s. And what was going on? People were worried about other things, tariffs, and that they were going to slow the economy and people would buy less crude oil, drive less, travel less, because people were worried about money. OPEC Plus came out and they said, oh, surprise, we're going to increase how much oil we bring back, bring that 400,000, so 3 times what the market was expecting, right? And there was a lot going on. All the banks had changed their forecasts and said, oh, you know, we're going to be 60s, we're going to be 50s. So there was less interest in this asset class. And we were losing some of our backwardation, right, where the market is higher in the front than it is in the back. But now with this one, and we've been talking about these things in the background, like the risk to Iran, the risk to Russian Russia-Ukraine, like a lot of other things that are happening. And we try and warn investors, these outlier risks that could happen. And that's why you want to have commodities or something like DBO in a portfolio, just in case. But everything changed in the past 2 weeks. And that's why we're joking that, again, the returns for equities over 2 weeks, 1%. Turn for commodities over 2 weeks, like in the teens.
Talk a little bit about the exposure to commodities. Is it oil specifically, or is it commodities as an asset class overall? And what should the makeup be, therefore, of oil within the commodities group?
I'm totally biased, Scarlett. So I'd like to say grew up in the energy market, right? And I've done commodities for over 30 years. And I love the energy market. But you're right. Broad-based commodities is a much safer bet because you don't know which commodity is going to be going up. Like gold right now, geopolitical risk, you want to have gold. And that's why we do talk about our broad-based ETF, this PDBC, which actually Eric Balchunas I know loves because he always brings it up. He's a holder, I believe. But generally, as you wouldn't buy one stock, it's sometimes dangerous to buy one commodity, right? And we see that now with the industrial metals. We talked previously about copper and how it was going crazy with the tariff, the concern about tariffs and the Section 232. So broad-based commodities do tend to make more sense.
Right.
But again, we're glad that commodities are now in the forefront of people's minds, right? So we finally are getting that look. But I feel responsible that we need to educate people. Don't chase it when it's skyrocketing. But also, we don't know the future. There's a lot of uncertainty ahead in terms of how this conflict is going to work out.
Right.
Could it escalate? Right, even today, right? Iran says that they want to de-escalate, but now other things are happening. There's more attacks. And we haven't really been hitting energy infrastructure, right? There's been just small. Really, in Iran, it's been the domestic use, right? But there's a lot of levers that can be pulled that can be really catastrophic for commodities. So that's where some of the concerns are. And one is, I mean, again, a lot of people are talking about it, the Strait of Hormuz, right? The idea that Iran has a capacity to shut this. Now, we give that a low probability, but again, that is something where people are afraid to even put a price on. So that's why I'd say that commodities should be in people's portfolio, and DBO, again, an interesting choice, but you have to buy the dips, and when it goes down, be disciplined, be ready to execute.
All right, Kathy, that's a good place to leave it. Really wonderful to get some time with you. That is Kathy Kriskey of Invesco. And you can read about this drill down, plus all the latest in the ETF industry when you subscribe to my weekly ETF IQ newsletter. If you want the URL, here it is, bloomberg.com/ETF IQ newsletter. But that does it for Bloomberg ETF IQ, the television show. I'm Katie Greifeld, along with Scarlett Fu. Eric Balchunas also hopped in from London at one point, and this is Bloomberg.